I think the big unknown is housing. That's the one area of the market right now that seems stressed. Consumers are still doing fine, but housing is really stalling out. Home builders are struggling. The sentiment stinks. Mortgage rates are uncomfortably high. Affordability is too high. So we've got to figure out a way to kind of re-energize housing to keep the economy humming along and really the markets rolling. I think that could be the one risk that slows us down again.
Hello and welcome to the show. I'm your host, Alex Daly, Managing Director here at WorthNet, and today we're joined by Lou Basenese. Lou is the host of The Big Skinny and also the EVP of Strategy at Prairie Operating Company. Lou is known for making big, bold, contrarian calls about the market, and today we've got a lot to talk about. We're going to get into tech stocks, oil and gas, crypto, and more. But before we do, just a quick reminder, nothing in this show should be construed as personalized investment advice, a recommendation, or a solicitation to buy or sell any security. We're here to provide education about how professionals are approaching today's markets. And if you like conversations like these, please be sure to hit subscribe and let the algorithm know you want to see more from us. Lou, welcome to the show.
Glad to be here, Alex.
So, Lou, there seems to be sort of two big sentiments in the market right now. People are either talking about interest rates and Fed policy, or they're talking about corporate earnings, and they seem to be tugging in two totally different directions. Your take, what is driving all the market's momentum?
Yeah, it's earnings. It's always earnings, but I think you put a finger on it. There's this tension, and I think it's the natural tension that exists from people that are always glass half empty versus glass half full. So if you're in that glass half empty, kind of skeptical, prove it's trust but verify crowd, you're really worried about the Fed and tariffs. The Fed still is worried about tariffs, even though we haven't seen it materialize in the data. And I keep looking at just different data sources. Even the Fed's beige book shows that a lot of the companies themselves or the countries are bearing the brunt of the tariff impact. And, again, too, I would say it's hard to know what it's ultimately going to be, because one day it's 25%, the next day it's 135%, and then it's, ping pongs back and forth. So I think there's that crowded uncertainty there. Then you have the soap opera / political intervention from the president trying to bully Jerome Powell into cutting sooner. And then you balance that, though, with earnings, right? Like, I think people are seeing tariff deals get done, so the focus goes back to earnings. And by and large, the earnings prospects for the entire S&P 500 are pretty strong. This quarter, you see a much more performance coming out of the Mag 7. They're supposed to do about 14% earnings growth versus 3.2% for the other, what I call the unmagnificent 493. But as we move into Q3 and Q4 and exit the year, they're going to be on par, both expected to grow about 11% earnings. So you layer that on. I know that valuations are a little bit richer than they normally are, but if you're growing earnings at double digits, you can grow into those valuations. So I really see that. For me, I'm a fundamental investor. There's seasonality that comes into play, but at the end of the day, if earnings keep going up quarter after quarter, stock prices are going to keep going up. So I think it's a great bullish backdrop, even though we do have concerns over when. I don't think it's a matter of, is the Fed going to cut? It's just, when are they going to start the cuts?
Yeah, does it wait till Jerome Powell's out of office in 8 months, or do we see them bow to some of this pressure, or maybe respond to some of the data they're seeing? We had Lacey Hunt on the show recently, and he's banging the drum pretty loud that they should have cut rates 6-8 months ago.
Yeah, it's funny because I've been in the camp. I actually called Jerome Powell the Rodney Dangerfield of finance because he's getting no respect for the last 6 to 8 months. I was saying he should absolutely not be cutting. It's too early, but I've come around in the last, call it 3 to 6 weeks, just looking at the data and the lack of impact from tariffs. And I can say that, look, September, October, I think you need a cut. And if you want a metric to look at, well, what supports that, if you're not paying attention to the inflation, if that's not clear, if you just take the 1-year treasury yield minus CPI over the last 12 months, that's been a good gauge to see where real yields are at. We're at about 1.4% on that, and that's well above the 20-year average. So there's room to cut. And my argument is this: 25 basis points here or there is not going to make a huge difference. It's not going to be, like, hey, you push the nuclear button, you blow up the economy if you cut 25 basis points too soon or hike, 25 basis points. So I think it's not about the cut. I think it's about when does it start, because there'll be more cuts that come with it. But I'm definitely in the camp that come September, October, you're going to see that tariffs aren't having enough of an impact. And I think part of the equation no one's factoring is just AI. The deflation from AI is offsetting and counterbalancing the reinflation or any reinflation from tariffs, in my opinion.
That's an interesting take on it. As the market absorbs this news, see lower inflation, as you pointed out, strong corporate earnings. We're sort of ankle deep in earnings season right now. But I was talking yesterday with Chuck Carlson. He said things are looking relatively strong. So short of something like, an NVIDIA surprise to the downside or someone like Microsoft coming in weak on earnings, what could take the momentum out of this market?
Yeah, I think it's a great question that it keeps me up at night, right? Like I'm always an optimistic guy, but when I can't think of what's the risk that's on the horizon, that worries me, right? Because I like to be a contrarian too. When everyone thinks they're smooth sailing ahead, there's probably some external risk that we haven't thought about. I mean, for me, I really think it's it's got to be, I would have told you us bombing Iran would have been that disruption to the world. I mean, I work with an oil and gas company. I can tell you when those bombs were dropping, we were having meetings worrying about, is oil going to be at $120 when we wake up tomorrow? That didn't happen. That whole oil risk premium came out of the market. So I think the biggest risk is just the Fed being stubborn, really waiting, being data dependent. And I think, look, no one ever has perfect information in business. So if the Fed's waiting for a definitive all clear sign that the tariffs are not causing reinflation, I think it's going to be too late. So as I say that and think through this with you, live, I think the big unknown is housing, right? Like that's the one area of the market right now that seems stressed. Consumers are still doing fine, but housing is really stalling out. Home builders are struggling. The sentiment stinks. Mortgage rates are uncomfortably high. Affordability is too high. So we've got to figure out a way to kind of re-energize housing to keep the economy humming along and really the markets rolling. I think that could be the one risk that slows us down again, which thankfully it's not a 2007, 2008 kind of housing crisis. I think this is more of just getting to the right equilibrium for price and interest rates.
Yeah, that makes sense. And, nothing more sensitive to interest rates in the equities market than home builders. And they've been up pretty strong on this anticipation of a cut that you're talking about.
Yeah.
You mentioned oil and gas briefly. Trump has been drill, baby, drill. America wants to be the largest exporter of oil to the world under the Trump administration. Are we seeing that happen right now?
No, we're not. Not on a broad scale basis. And the answer why is really just price. For people that don't understand, I mean, look, we went from being a net importer to a net exporter of oil and gas in the US. So we're producing about 13.5 million barrels a day equivalent. The problem is we had all these wonderful, abundant shale resources, and we're getting to the tail end of those resources. So many people don't understand that those wells deplete really fast. So if you drill a new well, the production you get out of it in year one declines by 50% by the time you're in year two. So you're kind of on this treadmill to maintain that level. And at these current prices, the drillers are just not making enough money. There's not enough margin in that. So, I mean, everyone gets that, right? For oil, it's kind of like I can liken it to now like a more modern technological thing is with Bitcoin, right? If Bitcoin prices are high enough and it's cheap enough to mine and make a profit, you get more miners coming online. When Bitcoin prices drop, it's not economic, they stop. So the same thing in oil and gas. If it's not economic to pull the oil out of the ground and get it to market, you're seeing people draw back on the drilling, and you're seeing that in rig counts. So the president, from a policy standpoint, it sounds great. It's a great battle cry, drill baby drill. But if you look at the biggest players like Diamondback, they're actually pulling back on drilling. So I think, what does this all mean? Boil it down to one number that matters for energy. I think it's about $70 to $75. If oil is at 70 to 75, there's enough margin, even in the later stage Permian resources, where there's good profit to be had, and you'll see explorers continue to drill. You get to that 65, 60 range where we've been. That's one of those where everyone's, it's kind of, you wake up that day, well, we're not going to drill. We're going to drill. We're not. There's a lot of hesitancy, and you see that in the rig counts. I think we're at about 430-ish oil rigs operating right now. That's just enough to maintain our level. You need about 440 consistently to maintain production. So we're in that gray area, right? It's the danger zone. If it goes much lower, it's fulfills the president's promise if oil prices go higher and we can keep drilling some more.
I don't want to try to ask you here to be prognosticator of all things world events, but you said Iran, we're bombing Iran. We've got Ukraine, we've got tensions between India and Pakistan, so hotter than they've been in a few decades. If oil's at 60, 65 right now, what pushes it up? I mean, you would think this would be an environment, wouldn't you?
Yeah, so I think it's got to be the overall supply, right? So as you saw tariffs kick off, everyone worried that we're going to kind of slow down economic growth. That took some premium out of the market. The other thing, with Iran, I think they changed their tune really quickly. They talked and threatened about closing down the Strait of Hormuz. Only problem is the majority buyer of all of Iran's oil is China. So, that doesn't play very well with one of the other bigger economic powers. So I honestly think it's got to be a demand side increase to get prices moving higher. I think you're starting to see that now. You saw the Eurozone pause on their interest rate hikes, I mean, cuts, indicating that they're starting to see some economic recovery. We're seeing it in the US. You get clarity on tariffs, you're starting to see prices start creep back up because everyone's like, okay, the global economy can get back to growing again, and that will increase demand for oil. Yeah, I think it's hard to say that these. I always fear being a macro guy because there's 97 million variables that you got to get right, and even if one of them's wrong, you're off base. But in the oil markets, I think you can simplify it by simply, is there enough demand there to drive price higher?
Yeah, so if we can get this economy smoking, like is the intention of the big beautiful bill, a potential rate cut, all sort of pro-growth policies, that might be the thing that moves the needle, it sounds like. Speaking of unloved sectors, you've made a little bit of noise about how the big institutions don't seem to like small cap right now. Can you expand on that a little?
Yeah, they seem to be the redheaded stepchild of this current bull market. And, realistically, like, I've cut my teeth 20 years ago, really leaning into the advantage that we have as individual investors in small caps. They tend to run in really big cycles and outperform large caps. We're just in a long drought. It's like if the roulette wheel kept coming up red like 9 times in a row, which is very statistically improbable, but it happens. That's what we're seeing. Small caps, it's not that they're just tanking. It's if you look at the lows off the Liberation Day bottom, small caps are up 29% versus large caps at about 30 or 31. So they're keeping pace with large caps, but they haven't been, if you broaden out the view a little bit. And the ironic thing here, we go back to the early comments about earnings driving stock prices. Small caps deserve to underperform last year because they reported earnings declines of 18%. Fast forward to this year, the projections are for 11% growth, and then we get to almost 30+% in 2026. So I think institutions have just, look, with so much uncertainty globally and for the US economy, the ones that are most impacted, the companies that get the most hit and are sensitive to interest rates are small caps, domestically focused. As we get clarity there, that it's kind of the all clear on the tariff trade war front, the global economy, I think you're going to see a resurgence of interest from the institutions, which sets up a great opportunity, right? Like there's Rick Rule. We talk about all these great names in the finance world that we've dealt with before. Rick always had this comment: you're either a contrarian or a victim, right? I'm the contrarian on small caps right now, a little bit early, but everyone else is starting to come over to that side. And I think if you don't, you're going to end up being the victim that's betting against small caps. That it just won't work out well 6 months from now.
Let's turn to another asset class that's been sort of flat of late, which is crypto. Crypto had this huge sort of record bull run, and now it seems to have cooled off a little bit. And with that cooling, I'm also sensing sort of a change in rhetoric from you. You were always a crypto skeptic, Lou, but some of the notes coming out of you right now seem to have gone the other direction. What gives?
Oh man, I started hanging around in a church congregation with like the likes of Anthony Pompliano and Tom Lee. And yeah, look, I'm a forever curious guy. So I would say this. Tom Lee said it best, and I think he can be promotional, but he said, look, there's never been in the history of the world an asset that goes to $2 trillion in market cap and then just disappears. So it's one of those things where I thought crypto was kind of a nuisance and a speculative thing that was flying around that you just have to deal with and tolerate. And then really the thinking has changed because I do see it. Yes, there's that speculative side that typified it in the early days, but now there's a real functional side. I think it was the research head at Coin Center put it to me this way that just resonated. Bitcoin is the first, it's revolutionary because it's the first digital platform to exchange value without any middleman involved, right? So I think about that and he said digital, well, what about the physical one? Well, physical one was cash, right? I can give you cash as long as we're in person. We don't have to worry about trust and intermediaries because my dollar is a dollar and you're getting it. Well, Bitcoin revolutionized that for digital payments. So I think it has a functional purpose in the digital world. I think about it upgrading, going, all these businesses have upgraded from analog to digital. It's time for currency to do the same thing. And then you deal with a limited supply, right? So I think all that to say that I see a functional purpose for Bitcoin and crypto in the world. At the same time, I still see things that scream of too much hype. If you look at the digital asset treasury companies that are now in vogue, all these publicly traded companies trying to get into crypto, that artificially takes supply off the market and keeps driving up price. And then whenever this fad ends, you got to believe that these companies are going to monetize and dump supply onto the market, and it's going to lead to a downturn. So I don't know. It's the great quote: the markets can stay irrational a lot longer than you can stay solvent. So I don't want to try and opine on when Bitcoin rolls over as a strategy for public companies, but right now I can tell you I'm on a board of a company that we're pursuing this strategy because there's a lot of institutional demand. It makes sense in this type of market, but at some point it's going to stop making sense, and you're going to see a lot of money flow back out.
I mean, you're talking about these companies like Strategy, formerly called MicroStrategy, right? Where their entire
Yeah.
balance sheet is effectively all Bitcoin and other cryptocurrencies. That they're basically an ETF.
I think Wall Street loves it too, because people ask, well, why are institutions so eager to invest in these crypto companies versus an ETF? My understanding is a lot of them can't custody crypto easily, or they can't because of prohibitive covenants with their banks that they deal with. So if you put crypto in a public company structure, now it's just equity. And so it's easy to custody, it's easy to trade, and more importantly, it's easy to leverage with all the options and derivative strategies that Wall Street loves. So I think it's one of those things where it's something that they know when it's in common equity form versus crypto on in a cold wallet and off the grid kind of thing.
You follow a lot of individual names in tech, and tech has been the hottest part of the market. We got Nvidia and the Mag 7 and as you called them, the unmagnificent 493 out there. But the Mag 7 really leading the market. What names in tech are over or undervalued, too much hype or misunderstood in your mind?
Yeah, I think there's a lot of reason to be cautious in some of the fast growers. Like Palantir, I think is everyone's darling. It's the next Nvidia in their mind that can go up thousands of percent. Full disclosure, I don't own any Palantir. I'm not salty that I don't own it. But ask anyone. I do this. My fellow analysts, like, what does Palantir do exactly? Like, explain it to my 5-year-old, 6-year-old child, and they can't. Palantir knows everything about us, but we don't know anything about what it does really. But if I look at it on the pure numbers, it's trading at a richer premium than Google right now, and Google's growing faster, almost on the top line, has a lot more revenue and a lot more profit, and yet it's trading at what I consider bargain basement valuation because people are afraid they've missed the boat on AI or that Washington's going to break them up. And I own Google. I've been buying. I've said it's the only Mag 7 stock worth buying for the last couple months because of this fact that it's cheap, it keeps growing. Search isn't going anywhere anytime soon. They just reported results, and search actually growth was really, really strong, up by double digits. They're doing over $500 million a day in revenue from search, so that's not a dead business. It's doing over 208 billion in the last 12 months. So I really look at opportunity there. So you used to be able to buy the Mag 7 as a block, kind of set it and forget it. Let me just buy. They're all going to go up. I think the analogy I used is it's a boy band that broke up, and now you got to predict which one's going to have the best solo careers. And I think Apple is going to struggle. I don't know if it's the Joey Fatone of it, but the Justin Timberlake is probably, in my mind, the late bloomer in Alphabet, and we'll see. So I think it's a valuation play.
Gosh, who would have thought we got to a day where the contrarian play is Google?
I agree, right? It's the original kind of tech play, and now it's funny to watch. I mean, Gene Munster was just out on Twitter yesterday after the quarterly report and saying like, "Hey, I've been really negative, but these numbers are too strong to ignore." So I think you're seeing that tide, that sentiment shift, which is what always leads to the stock moving and much re-rating to a higher multiple and coming back in line. So it's a good development if you're in Alphabet now or considering a purchase before too long.
Speaking of tech, and you mentioned the 4-letter word AI, you can't go a call without talking about it right now. But I think the big news right now is Amazon talking about getting into this AI wearable space. We're talking more product than economy here, but do you see this wearable space like sort of coming into its own all of a sudden, or is this just Amazon chasing the rumors of OpenAI's Johnny Ive thing and just sort of saying like, hey, we're here too, don't forget about our stuff?
Yeah. Yeah, I think that's well put. I think it is. Look, we're over here. We've kind of marked our territory. We've got a stake here in case it gets really hot. But when I think AI and I see everything that's going on, I mean, 29% of Chat GPT is used for coding, right? 1% of GDP growth in Q1 was from AI investments in infrastructure and data centers. None of the stuff that's really jumping off the page has anything to do with wearables, right? I mean, yeah, the Johnny Ive, like maybe you're going to get there, but that's really that for me is the consumer facing aspect of any new technology is always later in the cycle, right? The earlier stage has always been defense, government related, or enterprise related. And I still think we're heavily in that side of AI where you're seeing all of the infrastructure investments benefiting the enterprise, not consumer facing, right? Like if you ask the man on the street or woman on the street, I got to believe still 1 out of 10 uses AI, right? Like it's just not part of everyday life versus, and that's why Google's doing so well because the other 9 out of 10 still use Google search, not Gemini or anything else that would put search out of business. So I see Amazon's foray here. I mean, I think Bezos, bred a culture that was opportunistic. I mean, he himself, purchases the Washington Post, now is rumored to be interested in CNBC. I think Amazon's always looking to have a foot kind of a toehold in all different areas and see what takes off. But like I'll use robotics as an example, right? Amazon was one of the early robot developers, but if you listen to the CEO now at being asked point blank, like Tesla's ramping up their humanoid robots, are you going to get into that space? And he's like, yeah, I don't know what we're going to do. Like they're not really putting a lot of development in there. I think this wearable acquisition will prove to be much of the same. Kind of like Zuckerberg in the metaverse, right? Like he put in $38 billion, and then how many of us are wearing just clunky glasses around and walking around in the metaverse. So I think
Yeah.
it's more of a fascination and insurance policy in case AI goes in that direction. I just don't see it growing into something meaningful for Amazon.
Yeah, though my teenage son would take argument with the use of the adoption of consumers. Every time I talk to him, he just took a road trip across the country before he heads off to college. Hey, where'd you find out about that restaurant? Where'd you find out where to park when you take the train into New York? Where'd you find ChatGPT, ChatGPT,
Yeah.
ChatGPT every single
There's
time you turn
definitely a
around?
generational divide. I agree. Early adopters are much younger. It's happening. I mean, someone said it best. AI is not going to take your job, but someone that uses AI is going to take your job. So you got to learn to use the tools. I see it as that. It's a new tool for this age.
Yeah. Speaking of AI, I mean, is this infrastructure spending and policy now is even leaning towards sort of like a what they're calling like a try first model of trying to just support as much build out as possible? Are we just back in sort of fiber optics, WorldCom, overbuilding infrastructure for the sake of with no rational plan? Or do you think that this AI build out, these hundreds of billions, maybe trillions of dollars that go into it are going to ultimately pay off in a productivity boom?
Yeah, I think it definitely pays off in a productivity boom. I look at it from the more of the mobile network side, right? Remember all the infrastructure investment in 5G, and then that literally unleashed Netflix's business, right? It went from renting DVDs to now streaming, and that infrastructure enabled that. I think AI does that on a next level. Some are calling it the fourth industrial revolution. Here's where I come down on all of it. We probably can find uses to increase productivity, use AI to really grow another boom, but there's one key bottleneck, and that's energy. Like, I don't think people are talking about it now, but I don't think everyone has a full context of how much energy we need and how much we may be winning in terms of AI chip innovation and patent filings and company formation versus China. But China's kicking our butt in terms of figuring out how to provide the resources to power AI. So one stat that jumps out at me, in the last 10 years, China's brought online over 8,000 terawatt hours of new electricity generation. The US is at about 500. So, we're at like a fraction of what China's brought online. And to put it in context, a single data center uses 1 terawatt hour of electricity in 15 days.
Well,
100 million homes run for a year off of 1 terawatt hour. So you're seeing that there's this huge supply suck for AI that I don't think we've figured out. Everyone wants to believe that nuclear is the silver bullet. The problem is, I talk with industry insiders, small modular nuclear, the over under on when it can be an effective solution coming online is like the year 2032. So we basically have, call it 5 to 7 years now, where we've got to bridge an energy gap. And the US has been going in a direction that was always renewables, wind and solar, but that doesn't work for data centers. You have to have 99.9999 uptime reliability. So Yeah, it's this world where I would say energy is key to AI. No one wants to think about it. They want to think about the flashy tech side, but the really non-techy oil, gas, wind, coal, solar, all of the above. I call it the energy addition. Forget the energy transition. We need all of the above and we need more of them. It becomes the key enabler. And if we can't figure that out as a US, as a country, I think we start falling behind other countries like China that, they've already embraced all of the above, the energy addition. They're going to open up more coal-fired power plants this year than they have in the last 10 years. So, they're all in. I think if we're going to be all in, we've got to be all in on energy policy as well, which thankfully it looks like we're headed in that direction.
Yeah, what kind of policy change needs to happen here? I mean, you said earlier that the thing that pushes up oil prices and makes energy stocks perform better is higher oil prices, that we are low despite all of this political instability. And yet AI has an insatiable demand for energy that nuclear is unlikely to meet in the next few years. When do those two meet and we see that oil price go?
I think the bills are being passed, opening up federal lands offshore and onshore. I mean, all the switches are being pulled and levers are being pulled and switches flipped that matter longer term. The problem is we're in a short term issue of we got too much supply of natural gas. So we got to work through some of those supplies. And then we also have to it's actually the way to work through it is now what we're doing is we're saying we've got to bring more natural gas powered electricity power plants on, more nuclear, more coal. That will pull through and quickly eat up the slack in the system of resources and then lead to more demand. The big beautiful bill did eliminate a lot of subsidies for solar and wind, which I'm of the camp. I work for an oil and gas company. That does not mean I'm anti solar and wind and renewables just by default. But when you have to subsidize something when the economics don't work, you have to revisit that. So I think what happened with the big beautiful bill, you get those subsidies out. Now solar and wind need to stand on their own economics. And I think tech innovation will enable that to happen. So I think there's a convergence that happens in the next 6 to 12 months that provides the power that we need to become a leader and stay a leader in AI. But there's this rebalancing that's got to happen in the market. And that's why I think you're going to see a lot of volatility, both in stocks or the commodities markets. I think that's the new norm. You get volatility because the smart money on Wall Street thinks the retail money is dumb money and they're fighting back on meme stocks. And I think we just have to get used to that. I mean, there's no smooth sailing anymore in this world.
Hey, if somebody wants to follow you as you follow this energy market over the next 6-12 months and all these developments in technology, how can a reader reach you?
Yeah, the easiest way, find me on X, Lou Basenese on X, or at thebigskinny.com. I've got a newsletter that I send out there, and we do a weekly show where we talk about, look, we have information overload. There's a million headlines to follow and track. What are the ones that really matter and impact your portfolio? We like to do it in a very short hitting, kind of entertaining way. So no 30-minute explanations. We try and cater to this new digital generation that likes things in bite-sized segments. So yeah, that's the best place to find me.
All right, great. Thanks a lot for the time today, Lou. Really appreciate it.
Great to meet you, Alex, and appreciate you having me on.